To start off, ETF stands for Exchange Traded Fund. So the best way I can describe an ETF is that it's basically a mixture of a mutual/index fund and an individual stock. So basically, if you don't understand what that means, a individual stock is really cool because it is a backing of an individual security, i.e. a share in a company, commodity, or other type of security that anyone can buy with a generally low threshold to entry, i.e. you can download Robinhood or Webull or any of these mobile investing apps, and you can, with very little effort, without having to pay commission fees on those specific brokerages and on many brokerages today, you can buy a stock. And usually it's going to be a pretty low price relative to what mutual funds or index funds will cost that are not ETFs. So what a ETF is, what it seeks to do essentially is to get the diversification of a mutual fund or a index fund, i.e. lower the risk relative to an individual stock, but be more accessible to the average investor. And more specifically, it's a collection of securities, which are stocks, commodities, or bonds, generally speaking. And it's good for being able to have exposure in more stocks with less commission fees. So if you do use a brokerage that has commission fees, then each time you invest, i.e. buy or sell a stock, then you would have to pay a fee. ETFs, what they allow is, say you want to have exposure into 10 different stocks instead of one, and that way you spread your risk a little bit more. Instead of having to pay 10 separate commission fees, you just pay one for that ETF and you get exposure to all of the underlying stocks within it. They usually track a specific segment of the market. So there will be examples of, ETFs that track gold, they track silver, they'll track automotive, they'll track, electric vehicles, or any, or the S&P index, so the S&P 500. They'll usually track a specific segment of the market, and that's, what you're looking for is exposure in that area. And they're different from mutual funds because they're traded directly on a stock exchange, whereas mutual funds it's through a broker. What happens is they take the money from a bunch of different investors, they pool that money, and then use that to then buy shares or, interest in the underlying stocks. And that gives them a little bit more leverage power because they're moving a lot more money. As an example, if you look on a lot of stocks, they're going to be something that the average person can afford as far as a price tag. But if you look at a mutual fund, like in Fidelity, one of the ones that I have, that mutual fund is, $290,000. Like I don't have $290,000 invested in that, but I have access to it because of the, arbitrage essentially of all of these different investors. So that's kind of the difference. So the pros of an ETF, they are more diverse. They have more diversification than individual stocks, which means they're generally less risky. Depends though, you got to look. And they can offer a higher upside than some index funds, at least in the short term. So it's important to understand that historically, you're most likely 98% of the time going to be better off just buying S&P index funds than almost anything else. But ETFs, like say you're following an ETF that is a heavy tech ETF. In the last couple of years, tech has heavily outperformed the S&P 500. So that would be an example of a market segment that you could, follow through an ETF that could possibly outperform the S&P 500 over a given time period. So that's one of the reasons. It's also a little bit more exciting than just buying index funds if you want to be more of an active investor, which I don't necessarily suggest, but that is something that, at least emotionally can help you maybe get more into investing. And then it can offer access to leverage without the need for or the risk associated with a margin account. So what margin is, so let's say I am a person coming to buy stocks, and let's say I have $1,000 in my account. Well, if I have $1,000 in my account, then let's say I want to buy a stock that's $100, like Apple's around $100 right now. Let's say I want to buy a stock that's $100. I could either buy 10 shares of Apple, or I could buy, 5 shares of Apple and then buy something else so I don't have all my eggs in one basket. Or what I could do is I could have a margin account where I am able to trade with more money than I have. I absolutely do not suggest this, and most people should never think about doing this, in my opinion. But basically, you would pay a fee in order to have access to this extra debt, essentially, and then be able to invest with that debt. And the reason you would do this is because if you are correct that stock or that security is going to go up, then you end up getting double or whatever the multiplier is, depending on the amount of margin that you have, extra gains. And leveraged ETFs are a way to, basically take advantage of this. However, since you are not individually trading with margin, it's actually the investment fund that owns the ETF, like the underlying investments of the ETF, then they are the ones taking on the margin risk. So it helps limit your downside risk, because an ETF is it's created by an investment fund and they own the underlying securities, i.e. stocks, commodities, bonds, whatever. And then you are buying that financial product from them. So there's going to be a little bit of a fee associated with that, because they're performing a service so that you can, have access to those underlying securities. And it can offer, another pro is that it can offer creative ways to invest for new investors. Along with leveraged ETFs, there's also things called inverse ETFs. And these are for people that don't want the hassle or the risk of trying to short stocks. And I will go over leveraged and inverse ETFs in the next topic. So I'll do a deep dive on that. Another pro is that you can offer access to companies that may be prohibitively high in share price. A good example of this is ARK. So ARK has several different ETFs. It's one of the most popular investment firms. One of theirs, and one of the claim to fame that they have, is that Tesla is in almost all, if not all, of their main ETFs. And one of theirs is ARKQ, ARKQ. That ETF is about $55 per share. And within that ETF, you have access to Tesla and Google stock. So if you're someone who has less money to invest, you're probably not going to spend $1,000 on a share of Google or $400+ on a share of Tesla. It's much more accessible for you to be able to buy $55 shares of ARKQ and have some access to both, because some is better than nothing. And then the last pro that I have is that it can be less complicated than picking mutual funds, because with mutual funds, you have to do a lot of research of looking at the fees and the performance and what are the underlying securities. And you have to do some of that with ETFs. But the difference is that with ETFs, the fees are generally baked in, meaning that, like, if you're buying this on, say, Robinhood or most, brokerage platforms, you won't even see a fee. That's also, something to be aware of, but it makes it a little bit less complicated for the beginning investor, which can be a positive. As for the cons of ETFs, because of what I was just saying, they are often misunderstood by retail investors, and I'll go over some specific examples shortly. And often they can be hard to sell if the volume is low. So as an example, whenever you look on a stock trading platform, and I will pull up an example. So if we were to look at, say, Yahoo Finance, and let's look at, say, Tesla, right? So if we look at Tesla, we should be able to see average volume. So the average volume, 82 million, right? Okay. Now, if you don't have any perspective on what that, means, as far as, is that a lot? Is that a little? Here's an example to show you perspective. We'll look at ARKQ. ARKQ contains Tesla within it, but ARKQ is an average volume of 2.1 million. 2.1 million versus 82 million. Volume is the amount of people that are selling and buying stocks, and given a trading period. And that's really important to understand, because if there, say a stock is plummeting or an ETF is plummeting and you want to get rid of it, if there's not enough volume of buyers to pick up those shares, then you may get stuck holding a stock while it falls downhill. And that's something that I've experienced before with ETFs, and it is not a fun time. So something to keep in mind. And you should always be looking at the volume that stocks are traded at, especially if it's more risky or short term, because it can bite you, and that's something you should always look at. And then let's look at an example of ARK so you can see how this works. And let's share this back with you. And let's look at actively funded, actively managed ETFs. And let's look at ARKQ, the one that I was talking about. So ARKQ is a good example. They look at autonomous and robotic ETF. So they're looking at companies that are investing in or are, doing business in those areas. And let's look down and let's see what they're holding. So these are their top 10 holdings inside of that ETF. So if you buy a share of ARKQ, then 10% of what you've invested is going to be in Tesla. And then you're going to have, 3.6 in JD, 3.5 in Alphabet, which is Google, and so on. And that is, the way that an ETF will look when you actually go and do some research. And we will come back to this later so that you guys have a little bit more of a explanation on what you should do, in my opinion, when you're looking for ETFs. Now, when we're looking at the other con that I'd see is that because of the hidden fees that are baked in and make it simpler, at least from the outset, it's important to look at these and make sure you understand what you're paying for, whether directly or indirectly, before making a decision. So let's look at some examples. I want to show you some examples of ETFs and mutual funds. So when it comes to Fidelity, that's who I use for my retirement investing. And I like to use, specifically, I use S&P 500 index fund. That's my primary thing that I go for. And that is FXIAX. And this is an S&P 500 index fund. And as an example, one of the most common ETFs that tracks the S&P 500 is SPY, SPY. So just so we have a general understanding, most of the time, mutual funds are more expensive than ETFs, and that's a positive for ETFs. However, index funds are usually less expensive than ETFs that track the same index. As an example, FXAIX that I was talking about that I use, it has an expense ratio of 0.015. Now, let's show, and I'm going to show you the calculator on this. Whereas SPY, that ETF that tracks exactly the same thing, SPY has an expense ratio of 0.095. Now, why does this matter? This matters because when we're looking and we're trying to see how much this is going to cost us, I think it's really important to understand, and this is also linked below. Let's say, in an example, you're a pretty normal person, right? Let's say you only have $1,000. So we're even starting pretty small. And let's say your future annual contributions, let's say you don't even max out your Roth IRA. Let's say you just put in $5,000 per year. So about $100 per week that you're saving. And let's say that you are a pretty normal person. You haven't been able to save until paying off student debt or, whatever it may be. And you're starting at 30. So this is not an extreme example. This is a pretty normal example. And then let's say 8% per year, because that's the general return in the S&P 500 adjusting for inflation. And let's say, let's look at our two expense ratios. So we saw that SPY is 0.095, and I might have to log in. I do not. Great. And FXAIX, we can see the expense ratio here is 0.015. So I'm going to go here. This is my Fidelity. So we got 0.015. And fund number 2, this is going to be SPY. So for SPY again, it is 0.095. So when I put this in and I calculate, so over the course, of 30 years, so from the time of 30, 30 to 60, then this is going to cost me about $8,500, and they are literally the same thing. Like the underlying investment is the same thing. There is no reason to pay that because you're not going to get anything different out of it. So understanding things like this is really important when you're making a decision on whether to buy an individual ETF versus a index fund. Make sure you are always looking that up and knowing what you're investing in. Now, coming back to the topic away from the screen, what I want to talk about is when we're looking at these, it's going to really depend, right? As an example, I point out that SPY is a rather expensive one, and I find that funny because a lot of day traders really like SPY. But if you're a normal investor that's going to be buying and holding, in my opinion, the better ETF for S&P 500 index fund is going to be VOO, VOO, and that's through Vanguard. Instead of having that 0.095 fee, it only has a 0.03 fee. So it's 1/3 the cost, and that's still double the Fidelity Index Fund. But if you're a person that doesn't have access to that through an employer, or you don't have a brokerage account set up and you're just getting started and you just have Robinhood or Webull, then VOO, in my opinion, is the best for the average person to go after. So definitely check that out if you're interested in buying index funds, which in my opinion everyone should be. Now, mutual funds are actively managed and indexes are generally, not. They follow an index and it's passive. So that's why mutual funds are going to be more expensive. And so the advantage, though, is that mutual funds, presumably a financial advisor who knows more than you is looking out for you, and they're actively managing it and moving your investments around. Most people, like historically, if you look at the different examples, they're proponents of each. Dave Ramsey likes mutual funds over index funds. Warren Buffett likes index funds for the average person. I tend to side with, Warren Buffett. He has much more of a track record. And generally speaking, index funds are going to outperform 98% of mutual funds. So in my opinion, the best thing is just to get index funds. And that's what I generally do when it comes to my retirement investing. But I will go over that shortly with more detail. Now, there are, generally speaking, 8 that you can break these down any way you want, but I have 8 different types of ETFs I want to go over. So the first are index ETFs. Index ETFs track an index like the NASDAQ or the S&P 500. Examples for these are, for the NASDAQ, QQQ, and for the S&P 500, as I mentioned before, are SPY or VOO. And let me share my screen because this is too many acronyms for you guys to remember. So we're following along here where we have the types of ETFs, and we have now second is industry ETFs. So industry ETFs follow a specific industry. The examples that I have here are the esports industry, which is nerd. They're usually very memorable like this. That's the goal, is because they want average people looking at them, and knowing just like when you type in a search term, it makes it easier for you to come across them. And low carbon energy, smog, SMOG, and then, as I pointed out before, ARK-Q, which is autonomous tech and robotics. And ARK has a lot of different investment options, as I pointed out earlier, and I will go over some of those later. Bond ETFs. So bond ETFs essentially follow the bond market. The bond market is, generally speaking, used as a hedge against the stock market because they tend to do well in times when stocks are doing poorly. So this is something that a lot of people like to use to mitigate risk. They have ETFs for that as well. And I think that the Vanguard Total Bond Market, BND, is my personal favorite out of those. Commodity ETFs, you have gold. So, and as you can see, they're pretty memorable, like GLD, IAU, because AU, the symbol for gold, like the chemical symbol, and then silver, corn, ethanol. They even have soybean as a commodity. So a commodity is, generally speaking, something that is, has economic value, but does not produce economic value. It is, something that there is a limited supply of, and, it tries to track the demand curve of that. Currency ETFs. So this is a way where people that are not, at a point where they want to trade Forex, i.e. looking at the changes between different currencies, this is a way that they can still have access to the currency market. And examples are, the Japanese yen and the euro, and, every currency under the sun, there's pretty much an ETF for it. So that is a good way to dip your toe into understanding that market before trying to do something like Forex, which I do not do. Inverse ETFs. So inverse ETFs are ETFs that are used to simulate shorting a stock. These are the prominent examples are SH, which is a 1x short of the S&P 500, and then DOG, because it's dogging on the Dow, which is a 1x short of the Dow. And then leveraged ETFs are the next one. Leveraged ETFs are those ETFs that allow you to basically, trade as though you have a margin account without some of the negative aspects. And those are, TQQQ, which is a 3x leverage of the NASDAQ. And then, Gold Miners Bull NUG-T, which is a 2x of a gold ETF. And then you can even have combinations, and there's way, way too many different types to mention, but these are the main types that, people should generally know about. And, a good example of this is, as I pointed out with TQQQ, you have, SQQQ, which T is the, triple leveraged, and then S is the negative triple leveraged. So this would be an example where if you think that it's going to go down, then you would buy the triple short if you were very confident, and then when it went down, you would gain 3 times as much. So that's the kind of the idea behind it. And they have this for, semiconductors. So that's why we have a semiconductor bear 3x. So this is an example where you have semiconductor, so it's on a specific segment of the market. It's an industry ETF combined with a inverse ETF because it's a bear ETF, and then combined with a leverage ETF because it has a 3x margin. So there's tons of ways that, there's tons of different basically products that these investment companies come out with for you to invest in as a young investor. And I think that's really important for new people to understand, because we should not be investing in things that we do not understand. Now, I want to point out that everything that I've mentioned here, other than the Fidelity S&P index funds that I use in my retirement account, I do not buy any of these or have an interest. So, this is nothing personal whatsoever. These are just examples. And overall, what I would say is that ETFs are great for new investors because they're going to help give you diversification without having to worry about making sure you're not getting hosed on actively managed fees. They're also a really great way to learn about stocks because, at least on a macro level, because you get better at viewing, if I'm looking at, say, semiconductor ETF, then I'm at least learning something about that macro trend in the market as a whole, as opposed to speculating on individual companies. And I think that's a better long-term way for someone to learn how to invest in the market and see trends both up and down. And, as I said, it's vital to know what you are investing in and to understand the product itself. And that's why it's really important that you read the stuff for ETFs. And as an example, I'll show you back on the ARC-Q, just so you have something to look at. So when we're reading ETFs, we want to always research them and understand what they, do, what they are. So when you look here, you have, the ticker symbol. If all you know is the ticker symbol, you should not be investing in it. Then what we want to know is, okay, what is the expense ratio? Okay, 0.75. That's pretty high. Remember, for the index fund, you're generally looking at 0.03. So this is a very high expense ratio. That being said, we want to look at, okay, how well is it performing? What's our, general, gains? Is that something that's going to be better than the index fund? If it is, then maybe you still want to pay for that. Also, again, if you want to have access to different stocks, you want to look at what are the stocks underlying it. If this is heavily invested in Tesla, and I think Tesla is not great, but I want access to, JD and Alphabet, then I probably don't want to invest in the ETF that's, going to be heavily influenced by Tesla, relatively speaking. And then you also want to look at what's the description. What does the fund do? We'll go over this more specifically in the next topic. And you want to, read about it. Make sure you understand it very well before investing in something, anything, ETFs and otherwise. If you enjoyed this clip, be sure to leave a like, subscribe, and check out the full live version of the Wealth for 99 podcast, where we talk finance, economics, and public policy from a working class perspective. We'll see you there.